This video contains a replay of a presentation that I recently gave at a Quant Insider webinar. Unfortunately, the recording started a bit late, so here I will just reintroduce it and then continue to the actual replay. The title of the presentation is Next Generation Investment Framework, and at first you might think that this is a bold statement. But what you will see during this video is that there exists a practically feasible alternative to the current mainstream variance-based approach, which solves many of the fundamental problems. So basically, this investment framework and its methods are carefully presented in the Portfolio Construction and Risk Management book. And you can actually get access to the latest PDF version of the book by following this Substack link or scanning this QR code. So if you go to this link and you scroll down to the bottom, then you will see that there's a download button where you can get the latest version of the book. So I'm still editing this book in public. So if you see something that is unclear or even worse, you spot a typo or something like that, then please let me know so I can correct it. So to the book, there is also accompanied Python code, which you can find on this GitHub link or by scanning this QR code. So here, if you go to this link, you can see that there's a code folder, and there for each of the chapters, you will find Jupyter notebooks that illustrates the examples. And basically this Python code, it's an integral part of studying the book, because the book will present the theory and show you the results of the case studies, and then the code actually shows you how the computations have been performed, so that you can verify that you also understand these methods from a practical perspective. Alright, so the remaining part of this video will just warm you up for really studying this book carefully so that you have the full overview of how to approach it, and it will probably make things easier for you. So now we continue to the actual replay. Just for you to understand where I'm coming from when I start talking about these academic theories and methods. So basically, I myself have a traditional quantitative economics and finance background, and then I did one semester of machine learning courses at the University of Copenhagen while I was working full-time. And yes, I was a teaching assistant in mathematics, statistics, and econometrics, doing a lot of programming, and this is what I believe are the main benefits of university education, because these are the things that will actually be useful for you in practice. Because when I started my first job in equity derivative strategy at Nordea Markets, so this is the biggest bank in the Nordics, I could immediately realize that although I had all these quantitative finance courses and I knew everything about probability measure changes and prices and things like this, I didn't really understand what a derivative contract was until I actually worked with it carefully from many different perspectives. So this is an important point, that although the mathematics and the programming is useful, then there's nothing that can replace practice. So basically, you need to experience in the real world what are the actual issues so that you understand how good solutions they look to these problems. So I always wanted to work with investment management. So that's why when there was an opening at Danske Bank, I joined that company and worked with portfolio construction and asset allocation. So basically, I had the same experience here because I could see all the things that I studied at university about covariance matrix estimation, gauge models, mean variance optimization, and all these things. They were not very useful for us to get good insights about how we should build our portfolio in a smart way. And basically, one of the main issues is that we were always talking about what is it that will happen in the tail risk scenarios and how are the dependencies in these scenarios. While when you work with mean variance, Black-Litterman, and things like that, it doesn't really allow you to analyze these things. So early versions of the framework and methods that you will see today have been developed here at Danske Bank, where I have used it in practice to manage complex multi-asset portfolios that include derivatives, leverage, and things like that. And this is something that we have done successfully. And we found that these methods are actually able to give us the insights that we want. So one thing I noticed at Danske Bank is that Since the mainstream technology is still variance focused, then basically many asset managers would sit around and try to solve the same problems and build technologies that would give them the necessary insights for building good portfolios, that's why we said let's start this company and build the core for them, which we deliver as a Python programming framework, which is a fast and tested and things like this. And actually, we have some institutional investors here in the Nordics using the system who also find it to solve the problems that they have. All right. So what is it then that is the big issue with mean variance, Black-Litterman, and things like this? The first obvious one is that these methods, they assume that markets, they behave according to these nice bell-shaped distributions, such as the normal distribution or the t-distribution. But as soon as we just do some elementary data analysis, then we can see that the real world is very, very different from these nice curves. So basically here, you can see the yearly return on S&P 500 for 20-something years. And then you have the best possible calibration with the normal distribution here with the orange curve. So this is if you exactly know the mean and the variance, then this is the best approximation that you can make. So what we can see immediately is that scenarios where you have lost 40 or 20% have happened much more frequently in practice than these nice bell-shaped curves will predict. And also, when we are using mean variance, there's also the fundamental question of what is investment risk? Because when we are minimizing the variance of a portfolio, we are also trying to minimize the upside as much as the downside. But of course, when you invest in the markets, then you're probably not worried about becoming too rich. And also, if you have some clients that you manage money for, they also would want to have as much upside as possible. So it is these scenarios where you experience large losses or drawdowns. That's what is perceived as investment risk. So everything we do is try to build portfolios in a smart way so that they perform well if we have these risk-off scenarios compared to mean variance. So there's also one thing with mean variance that people tend to forget is that when you have the covariance matrix, it only allows for constant and linear dependencies, no matter if the markets increase by 10% or if they fall by 40%. But almost all investment managers that I talk to, they have this understanding that there's one set of dependencies on the normal and calm conditions and another set of dependencies when we have these significant risk-off scenarios. And it's actually interesting that even the people who continue to promote and justify mean variance, they have this understanding that the correlations, they go to 1 in risk-off scenarios and things like that. But then somehow they still just, use one covariance matrix and mean variance analysis and things like this. So there is this logical inconsistency. And I would say that this is actually a common theme if you think about it for many of these academic theories. Okay. So the final point is that when you're using mean variance and making this elliptical distribution assumption, you're probably not making this mistake just for S&P 500. You're probably making it for all the investments that you have in your portfolio, because you can see S&P 500, it consists of 500 stocks, and they probably all have these nasty left tails that do not cancel out when we aggregate them into one portfolio. And even if you look at a multi-asset portfolio, you will also see that it has these significant losses and drawdowns usually. And some people, from university academics, they try to justify these things by a misuse of the central limit theorem, saying that, okay, if you have a well-diversified portfolio, it should be normal. But the thing is that the assumptions that underline the central limit theorem are just not satisfied for the investment data that we have. So we cannot also make the overall conclusion, and we can see that it's quite off here. So just to dive in a bit more into into investment distributions, such that the results are well established here. This is just some analysis from the portfolio construction and risk management book, which just gives us some elementary statistics for daily, monthly, and yearly returns. And when we look here, it's quite obvious that the deviations from the normal distributions are very significant because we have a very high kurtosis, we have some skewness. So what some academics then they try to do is say, okay, let's look at 1 month horizon. So 1 month horizon, we can see that the kurtosis comes down, but then we still have a lot of negative skewness here. So then they look at the 1 year horizon, and then they say, oh, but look here, for this technology index, the kurtosis actually comes closer to 3. So, this is the value of the normal distribution. But of course, this is a very, very naive test for normality, because we also must take the skewness into account. And even if you just look at these statistics, then there are many different distributional shapes that can generate these things. So basically, naive tests like this, just looking at the kurtosis, are used to sometimes in combination with the central limit arguments to try to justify that distribution on a longer horizon should be normal. But again, if you just look a bit at the data, that's not what we find, because if you look at this technology index, even though the kurtosis approached 3, then you can see it has some very, very nasty left tails. So basically, no matter how we twist and turn it, the current mainstream standard with mean-variance, Black-Litterman, CAPM, and all these things, it's probably not very useful to build good portfolios with good tail risk-adjusted returns. And actually, I think in many cases, it will be a recipe for disaster, because if you build your portfolios based on the assumption that these nasty left tails do not exist and that the dependencies are the same as in the call markets, well, then I think you are in for a lot of trouble. And this is also what we see when people try to apply these academic methods strictly from the textbook, then usually at some point it ends up blowing up. So just another comment here that I want to illustrate is that about the scientific quality of the mainstream fears we have at the moment. So if you do not know who this is the late Jim Simmons, who is the founder of probably the most successful quantitative investment management hedge fund. And they are very careful about hiring good scientists. And somehow they came up with this rule of thumb that they will not hire people with traditional finance and economics backgrounds. So, it should tell you a lot about the scientific quality of these methods and this framework. I would say that I believe that people with traditional finance economics background can still be good scientists. And I also see someone who actually tries to address all these issues in academia. But unfortunately, there is a big group who see this publicly funded academia as their own private business venture and wants to continue to sell this mean variance, Black-Litterman, and these things. So that's the people that I'm criticizing, and of course also some of the silent majority, because they are usually well aware of these self-serving biases in academia as it is right now. Okay, so just final comment is that for you to understand the issues with the academic theories is that they are usually exactly wrong, in the sense that they are very sloppy about the fundamental assumptions, and then they try to be very, very precise about the details. But it doesn't really matter if it's just an imaginary world which is very, very far from the one that we live in. So basically, you could also view it as it's very, very biased with a very, very low variance. So basically, people, they write papers about some adjustment to mean variance, some adjustment to a gauge model or something like this, but it all doesn't really matter if it's fundamentally wrong. So with everything that we do, we want to be approximately correct, in the sense that we have the fundamental assumptions being sound, and then we can allow for approximations in the details. So this is what you will see in all of the methods that are presented here. And this is also how I encourage you to approach your own modeling and your own analysis. So basically use mathematics, use programming, and then look at how the world really is, instead of starting by making many oversimplified assumptions, which is just wishful thinking in most cases compared to reality. All right. So this was just the motivation for why you should spend your time studying something else than the traditional mainstream stuff that you get. And now I will go through different elements and hopefully give you a larger overview such that when you study the portfolio construction risk management book, you have the right perspectives and it makes more sense for you. All right. So instead of working with just this mean vector and this covariance matrix, which reduces the market to an elliptical distribution, we have these fully general joint scenarios for the markets and risk factors. So basically, this could be something like in the columns, you have your marginal distributions for like Apple, Facebook, Google, or your risk factors such as interest rates and implied volatility surfaces. And then along the rows, you have joint scenarios for all these assets and all these risk factors. So you can then additionally assign a scenario probability that we collect into this probability vector called P. Since these scenario probabilities, since it's probabilities, of course, they must be positive and they must sum to 1. So basically, what you can see in this formulation is that it's much more general. In the most simple case, we can just use the historical data as it is, but even better is if we have some generative model which can generate new paths that have similar characteristics to the history, because of course we know that history will not repeat itself exactly, but we can probably still find some useful information and generate new paths with similar characteristics. So just to give you a more concrete example of how this matrix R will look, here we have a multi-asset study where we have government bonds, equities, hedge funds, and we even added a put option on those developed market equities. So here you can see that these are the marginal distributions along the column, and then along the row you have these joint realizations. So basically, this put option, it's written 10% out of the money. So the strike is 90% of the current spot. And you can see that in a scenario where developed market equities increase by almost 28%, then you are very, very far out of the money and you lose the premium on this option. But in a scenario where they fall by 21%, well, then you get the amount that you're in the money minus the premium that you paid. So this corresponds to a P&L of 9. So hopefully this now gives you a more intuitive overview of how this matrix R can look. Here on the right, you also see that we have different scenario probability vectors. So here we have a P, which is just uniform, assigns the same probability to all these scenarios. And that's usually the case in the prior simulation because it's the risk model that determines how likely different outcomes are. But we can assign non-uniform probabilities to these scenarios, which is given by this vector Q. And the way that we compute these non-uniform probabilities is usually using a method called entropy pooling. So instead of relying on the Black-Litterman model, which relies on KPM, on the normal distribution assumption, and has this strange tau parameter that introduces some logical inconsistencies also, we have this fully general and theoretically sound views and stress testing method. So basically, entropy pooling at its core, it's a minimization of the relative entropy or the KL divergence. And this theory is actually quite well known outside of finance, economics, academia. But since they keep focusing on the mean and the covariance matrix here, then it's not well known by finance economics students. But basically, the theory here is quite well established. And if you have uniform prior probabilities, then relative entropy minimization actually corresponds to entropy maximization. So sometimes if you read about the maximum entropy principle, well, it's the same thing with uniform probabilities. Once the probabilities are non-uniform, then you must do relative entropy minimization. So since these variables X that we optimize over, they correspond to scenario probabilities, we must require that they are positive and that they sum to 1. We can then use these linear constraints to implement views on the market. So basically, it's an important separation because it can be nonlinear functions, but it must be specified in a way such that the constraints are linear in the posterior probabilities. This is something that we'll talk about here in the future. So just to give you a quick intuitive understanding of what entropy pooling is, if we come back to this multi-asset simulation that we had before, here you see the prior distribution for developed market equities. And basically, this is just a log normal simulation. So this is still very, very simple. It's just something we use for illustrative purposes because entropy pooling can work for fully general distributions. It's not dependent on the distribution that you have. But anyway, here you can see that we adjust the variances, we adjust the skewness and kurtosis and introduce more mass into the left tails of developed market equities. And entropy pooling can adjust a bad prior in some way, but it's not recommended to use this method in that way. Ideally, you should have a good prior, and then you use this good updating method, which is entropy pooling, to stress test and implement forward-looking discretionary views potentially. So the good thing about entropy pooling is that it implements these stress tests in a predictive way. So basically here on top, you see the distribution for developed market equities again. So it's the same plot as here, just not as tall with some fill. And then you can see that even though we introduce some more mass into the left tails of developed market equities, then entropy pooling will tell us that if you are to respect the dependencies that are in this prior data, then you would also introduce more mass into corporate high yield. Of course, this is something we could have adjusted with a view if we didn't want it, but usually what people want is to have views on some core assets or core risk factors in their portfolios, and then have this predictive stress test of what will happen to all the other assets. So this is what entropy pooling does excellently. And it's actually just as easy to stress test a portfolio of S&P 500 or a portfolio of S&P 500 and then thousands of derivatives written on S&P 500, because entropy pooling will give us a consistent stress test, so we don't need to reprice these options once we have priced them in the prior. All right. So hopefully here by now, it's already clear to you that entropy pooling is much more powerful than Black-Litterman because it's fully general distributions, it's predictive stress test, it's many different moments that you can implement it on. So as I said before, one of the main limitations of entropy pooling is that views are specified as linear constraints on the posterior probabilities. It can be nonlinear views, such as views on variances, skewness, kurtosis, and things like that. But they must be specified in a way such that they are linear posterior probabilities. So basically, it requires us to fix some values. So for instance, if you want to implement a view on the variance, we must fix the mean of this asset that we are implementing the variance view on. But this can introduce some potentially strong implicit views. So this is what I found in practice when I started using the method. And this is why I came up with these sequentially entropy pooling algorithms that usually give much better performance. So basically, if you think about a portfolio where you have US equities and European equities, and let's say you implement a view that the expected return on European equities should be much lower than in the prior simulation, well, then entropy pooling will probably predict that the expected return on US equities will also be lower. So if you then have a variance view on US equities and you are forced to use just the prior mean, as the original suggestion is, then you can see that there is this implicit view that we want to avoid. So what these sequential algorithms, they do is try to come up with better fixed values that we can use when necessary. So basically, we would then take all our mean views and then process them first, and then we will get an update of all the mean parameters, which we can use when we implement our volatility views. Then we process the mean and volatility views, and then we can continue to skewness and kurtosis, where we can fix the means and fix the volatilities, and then finally until the correlations. So it's also possible to implement views on value at risk and conditional value at risk. Value at risk is very easy. You would have it here in the first step. Conditional value at risk in full generality is very, very hard. It requires some specialized algorithms, but it is possible. It is something that we have found fast and stable algorithms for. So this is the overview of the main views, and here's just an example of sequential entropy pooling versus the original one. So here on the left, you can see a joint distribution for developed market equities and emerging market equities. And basically, we implement the exact same views, but here we get much better results when we use the sequential algorithms. So for example, with entropy pooling, there's a related number called the effective number of scenarios, which basically tells you how concentrated are you in your scenario probabilities, and it has a inverse relation to the relative entropy. So the lower the effective number of scenarios, then the higher the relative entropy. So we want to have an effective number of scenarios as high as possible because this gives us a lower relative entropy. So here what you can see is that for the same set of views, we get a significantly higher effective number of scenarios, and we also get a distribution that looks more like something that we would expect in practice. So that's of course also an important thing. It's not just sufficient just to be able to solve the problem. We also want it to be a good solution. Another interesting thing is also that sequential entropy pooling allows you to perform some views and stress testing, which the original approach simply cannot solve. So here we mimic a tail diversification failure stress test. So you can imagine that you have a 60-40 equity and bond portfolio. We calculate the CVAR of this portfolio, and then we implement the view that the expected return of the portfolio should be equal to the CVAR. But not only that, the correlation goes from -30 to +30. So this is what you see here for the joint distribution, where the correlation was first negative. It goes to something which is positive. And you can see that there's a change in both the mean and the volatility of equities and bonds. But if we use just the original entropy pooling, which tells us that we have to fix means and volatilities to the prior values when we implement correlation views, well, then it's impossible to solve this problem. But with the sequential processing, it's no problem because we just process the means, the volatilities, and then finally the correlations such that we can get these scenarios. A good thing about these joint scenarios is, of course, that it allows you to quite clearly see what are the joint scenarios that you need to hedge if you want to equip this portfolio with a tail risk hedge, for example. So you can do something which is more clever than just outright hedging of, let's say, just the equity part or something like this, because, as you probably know, this is quite expensive buying, let's say, put options outright. All right. So how you come up with the entropy pooling views, you have full flexibility, and you can even also add some confidence in things like this. So it might be that one day you just woke up and you had a pain in your back and you felt that the expected return on S&P 500 should be 5%. So that's of course not how we recommend that you use this method, and there's probably not much alpha in using it in this way. But the point is that as an investment manager, you usually have some investment constraints, and then it's entirely up to you how you decide on the investment strategy, how you perform the risk management, and things like that. But what we find is that people usually want to have some additional structure on how they implement these entropy pooling views. So in many cases, taking some macroeconomic information and then transforming it into the P&L in their portfolio. So this is what this causal and predictive market views and stress testing framework that we have, where basically it's a Bayesian network on top of entropy pooling, and then the Bayesian network will generate joint causal views that you can then implement entropy pooling to see what the effect is. So here basically this is a Bayesian network that we use for testing and for illustrations, where we say that it's the economic growth, employment, inflation, and the central bank, and that drives changes in the core risk factors of our portfolio, which is the real rate, break-even inflation, and risk premium. So once we have set up this structure, it allows us to be logically consistent in everything that we do, because of course it's also quite hard to keep track of all these things in a qualitative way. So basically here on the next slide, you can see an example where I use this Bayesian net and combined it with entropy pooling. So here we just have this base case distribution. So this is after imposing the Bayesian net structure. And then we implement a stagflation plus rate hike view. So stagflation and rate hike. This is when growth is low, inflation is high, and then we have that the central bank still decides to increase interest rates. This is the scenario that most investment managers they worry about. So it's of course important to know how your portfolio distribution will be in these scenarios. And here you see that there's a shift to the left, so it's not a big surprise, but it's more interesting again also to study what happens to the individual assets, such that we can build good tail risk adjusted return portfolios. So basically here you can see you have the government bonds and you have developed market equities. And this is nominal bonds. So when rates go up, inflation go up, it's natural that the distribution for these bonds moves to the left. And the same thing here for equities. When growth is low and interest rates go up, it's usually not positive for equity returns. So there's also a shift to the left. The thing is, of course, that these results are not surprising, but it's good that we can have quantitative estimates of what actually happens and be very, very explicit in the assumptions that we have instead of just talking about it. Because, of course, most people intuitively understand that these things is probably what will happen, but then, what to do about it and how can we analyze this at a deeper level, it's very, very hard without the quantitative input. So this is what this framework provides. All right. So now we finally get to portfolio optimization. And it's interesting for me because people who are new to investment management, they seem to think that all that the investment managers do is just sit around and optimize portfolios. But it's actually quite far from the truth, because of course you need to do the modeling, you need to implement the views and different other adjustments, and then you can start optimizing your portfolios first after that. So there's a lot of work, before you can do these things. But then again, instead of focusing on mean variance, which operates on this mean vector and this covariance matrix, and has many oversimplifying assumptions that we have already discussed, and also it focuses on optimizing over portfolio weights, which also imposes some unfortunate limitations for modern portfolios that have derivatives and leverage. Then we use mean CVAR. So we optimize the conditional value at risk, focusing on the left tails of our return distributions. The good thing about CVAR is that it operates directly on these Monte Carlo simulations and probability vectors. So it doesn't matter how complex our simulation is or how complex our views and stress tests are, CVAR will give us meaningful results. So another difference that you will see is that instead of optimizing over portfolio weights, we optimize over portfolio exposures, and then we implement this self-financing constraint. Basically, this separation between exposures and market values. So this is what you see here. This vector V, it contains the relative market values, and this vector E, this is the exposures that we have. It's necessary for us to be able to handle derivatives in a seamless way. So if you think of a futures position, then of course it has some exposure depending on the notional and the direction that you decide on, but it has initial market value 0, and then there are some daily settlements. So the thing is that if you just focus on the weight of the futures positions, it will seem like you have no exposure. It doesn't affect your future P&L, but this is of course nonsense. So usually people, they try to do something with offsetting cash positions and things like this, but that is actually unnecessarily complicated, and it also doesn't really make sense if you have more advanced contracts such as a variance swap or something like that you cannot just get a cash exposure in. So once you perform the separation, and you can read about all the details in the portfolio construction risk management book, it's nothing complex or anything like that. Then derivatives become just as easy to handle as cash instruments. And then finally, we would always work with transaction cost, to make sure that we don't spend too much money, because of course, if we spend more on transaction cost, it actually also gives us less money to have exposure in the markets in the future. So it doesn't just directly subtract from our expected return. And it's important to have the self-financing constraints like this. Then finally, we just have constraints on the exposures. So this is whatever you can formulate with linear constraints. And if you do that in a clever way, you can actually do a lot of things. And this set is mathematically a convex polyhedron. For those of you who want that perspective. Okay, so here is just an example where we use this optimization framework and we compare CVAR optimization to variance optimization. So these are two portfolios, and this is like kernel density estimate of their return distributions. So this is smoothed out a bit. But even here, you can see that the CVAR portfolio has significantly lower tail risk, while it has significantly more upside. Both of these portfolios have the same expected return. So this is how they are aligned. If you actually go into this code, it's publicly available for free, and you study the scenarios, then you will see that there are very large differences in relation to the maximum loss and the upside for the CVAR optimized and variance optimized portfolios. So I encourage you to do that and then really see the big difference for yourself. And then here we have a posterior optimization where in the code we introduce some more mass into the left tails of this equity return distribution, so you can compare it there also. All right. So for portfolio optimization, it's also quite well known that it's very sensitive to parameter uncertainty. So basically here we have an article called Portfolio Optimization and Parameter Uncertainty, and we use mean variance to illustrate these results. But we would never actually recommend that you use mean variance to do investment management practice. This is just because it's fast, it's easy. So what you can see here is that for some expected return vector and covariance matrix, we compute an efficient frontier, and then after that we sample 10 observations from this distribution and then re-estimate the means, the variances, and the correlations. So what you can see here is that the means, they affect how the portfolios look a lot more than the variances and then the correlations. So that's probably the most important thing for you to take into account when you do portfolio optimization. So this resampled efficiency, it was actually introduced 20 some years ago. And then again, it was focused on the efficient frontier, on mean variance and things like that. But you don't have to do it in this way. You can use it for other risk measures, such as the CVAR and for single portfolios. And if you want to do something where you have derivatives, it's also good to use entropy pooling to make sure that you get consistent stress testing of them. So you can do a lot more than this original suggestion, and we present it in this article and then even more deeply in the portfolio construction and risk management book. So basically, this is what this slide illustrates, that we are not constrained to just using equal weights. So when this resample efficiency it was introduced, it basically said, okay, optimize the efficient frontier, let's say 1,000 times, and then select some index on the efficient frontier, and then just take an average over the exposures that you have there. So in this article, we show that it actually corresponds to a naive way of stacking, and then we come up with a better suggestion for how you can find these sample weights. So you can imagine something like, you have a portfolio with the same constraints, with the same risk target. You introduce parameter uncertainty, you optimize it 1,000 times, and then you need to figure out how to weigh these portfolio samples that you have. So this is what we do here with this resample portfolio stacking method. And basically, if you are familiar with these different machine learning competitions, then what we have seen in the past many years is that it's usually people who combine many different models that ends up winning them. So basically, one way that you can do it is a method called stacking. And what we do here is to use multivariate regression stacking, and then we apply it to, in this case, for example, the optimal exposures that we get. So this is just another way of finding these weights for this resample portfolio estimator. And the thing is that in this article, we analyze the out-of-sample performance of using this approach. So this is, of course, what we want to have a better risk-adjusted return in the future. So here you can see the distribution for the out-of-sample risk-adjusted return. So for the frontier portfolio, this is where we just do a normal optimization and then select one portfolio with no parameter uncertainty. Then you can see that it doesn't have as good a risk-adjusted return distribution as we can get. And then for this resample portfolio, so this is just the one that just takes equal weight as in the original suggestion. It's hidden there in between the green and the red curves. But you can see that if we use this twofold exposure stacking, then actually we can get better out of sample risk-adjusted performance. So this fold parameter is basically this L, how we split up the data in this case. All right, so it's just multivariate regression stacking applied either to the resampled portfolio exposures, or if you read the portfolio construction risk management book, you could also apply it to something like the marginal risk contributions or the marginal return contribution, things like that. So this is what we actually recommend that you experiment with to account for these diversification elements and things like that. So this method is still very, very new, and that's why we encourage you to really test it out to see, when it works well, when it doesn't work so well, because of course, we want to learn from these experiences, and we might also be able to give you some insights that are useful for you, based on our experience and the feedback. So please go out, test out this method. We have some open source code available for you for free, where you can solve this problem. Because although this formulation, it looks very, very complicated, we show in the article that it can be formulated as a quadratic optimization. So basically, we can solve it in a fast and stable way. Okay. So now, so far, we have just focused on the analysis methods. And we have just taken this matrix R as given. But of course, it's not trivial to generate good scenarios for the markets that we are interested in. So here, I just present the simulation framework that we use to do this in a good way. So basically, you would start with your historical data. So it has capital T observation and then N time series. This is usually how investment data will come. And then before you just start feeding this data into statistical models, then you probably want to pre-process it in a way such that it's easier for your statistical models to learn from it. So basically, that often involves a transformation into something which is stationary or approximately stationary or locally stationary, however good we can get it in practice. So this is what we call the stationary transformations. It has dimension T tilde, N tilde, because let's say if we do something with returns, then of course, we have one less return observation than the price observations. But of course, we can also do something that either decreases or increases the number of time series that we have. But usually in practice, this N and N tilde are the same. So then once we have these stationary transformations, we focus on simulating paths for them. So basically we say first how many paths we want. So this is this capital S, and usually it's like 10,000. That's the recommendation. And then we say which horizon do we want to simulate on? Because even though you have, let's say, daily data, you might still want to use it to simulate 1 month, 3 months, or 1 year into the future. So this is this capital H, that's the horizon. And then, of course, the number of stationary transformations, it remains the same. So, we have the history, and now we want to generate future paths, joint paths for these stationary transformations. Once we have these stationary transformations, then we want to go back to the data that we are actually interested in. So this could be the returns, the risk factors such as interest rates, implied volatilities, and things like that. And this is where we have this R tilde matrix. So it has still the same number of paths. S, it has the same horizons as the stationary transformations, but then it has the same dimension as the original data that we had, because this was what we were interested in the first place. So if we then want to analyze these simulations at some specific horizon, because although we do not assume that we live in a one-period world, so we simulate paths over time, then most of the analysis methods that we have, they are one period in nature. So CV optimization, entropy pooling, things like that. But that is also the same case for mean variance, Black-Litterman, KPM, and all these things. So it's not worse than that. But the thing is that when we have paths, we can actually make more interesting analysis than just buy and hold. So, for example, if we have a trend following strategy, we simulate some market variables, and then we can implement this trend following strategy and then look how its return distributions are at some horizon, let's say 3 months into the future. Also, if we decide to implement some tail risk hedging with a put option, one strategy is just to buy the option, then hold it to expiry. Another strategy could be to buy the option and then delta hedge it to realize this gamma over time. So that's actually possible to do when you have these paths, and then you just analyze it at the end when you do stress testing, optimization, and things like that. All right, so this RH, that's usually the matrix R in the end that we want. So that's the general framework. And now the question is, how would we then approach to actually generate these simulations? And of course, there exist many different methods. So you could do some generative machine learning, some other things. One of the things that we suggest is to use resampling. And the good thing about resampling is that no matter how high dimensional your simulation is, or how many time series you have, or how complex the cross-sectional dependencies are, then resampling methods will be able to capture them in the cross-section. Where resampling methods, they struggle is to capture the time series dependencies that are still remaining in the stationary transformations that we have. So this is why we recently introduced this time and state dependent resampling class, where basically you can introduce some time dependence such as like exponential time decay, but also some state dependence. So here, what you see on this plot is basically probability vectors for the historical observations. So here, we have something like 20 years of daily data, and then each of these green, bar charts, they correspond to a probability vector. So they all sum to 1. So basically, 1 is when we have a high volatility state, 1 is we have a medium volatility state, and then finally, we have this low volatility state. Sorry, my screen is just blinking at the moment. Okay, now we're back. So basically, once we have these things, we can also more better capture the time series dependencies that are in our stationary transformations after we perform the resampling here. I have some issues with my screen, so I just have to try to fix it. I don't. Okay, it's blinking on my side. That's why it might be confusing. Anyway. So when we do this time and state dependent resampling, then we are able to capture all elements, and that's what I will show you here. So basically, there's also one approach that in the current mainstream we have something like there's a common type that we have a long-term model and a short-term model, and this creates some issues when you do one simulation that you want to do. So that's not what we recommend. We recommend that you use the same model, and then basically what you would see is that the current state, it matters more on the short horizon than on the longer horizon. So here, for instance, you see 1 month return distributions for the equity index. So if we condition on having a low implied volatility, well, then you see that the distribution is a bit narrower, while if you condition on a high implied volatility, then the distribution is wider. And then if you condition something medium, well, then we are in between. So this makes sense. But if you look at a longer horizon, then you can see that this state dependence starts to disappear. So you can also think about it that if the VIX is high right now, well, then in 1 month's time, probably the realized volatility is higher. So even though VIX is not a perfect predictor of the realized volatility, it has some predictive power. But on a 1-year horizon or 3-year horizon, then it doesn't really matter what the value of VIX is, or at least not as much. The state dependence here should disappear. So One of the excuses that people usually use for having this separation between a long-term and a short-term model is that on the short term, you know what you have in your portfolio, and in the long term, you don't know what you have in your portfolio. But this is just, a rebalancing assumption, and you can't really get away from it because, usually these long-term models, they are more simple than the short-term ones. For us, if you just focus on simulating the risk factors, then you can perform all the pricing and all the rebalancing that you want afterwards, and everything will be simulated in a consistent way. So this is what we show here, that generally you want to focus on simulating risk factors. So here you see a 1-month distribution of a government zero coupon curve. So you can imagine that this is something like the US government bond curve. And once we have a simulation for the interest rate curve, we can, of course, price all the US government bonds that we want based on this. So here, actually, you see 10,000 different interest rate curves that you can then use for pricing however you want. And if you have some bond portfolio where you want to maintain, let's say, a duration of 7 years, something like that, well, then you can easily do that through the rebalancing when you simulate longer time into the future. And this becomes especially important when you work with derivatives, because let's say that if you have some historical data for a put option that lived for 3 months at some historical period in time where the market was at some specific level, then of course, if you just resample, these prices or these returns, then it doesn't really make much sense into the future. But we can probably learn something that can be useful for future simulations about how the implied volatility surface behaved during that period. So that's what we would do, take the implied volatilities and then simulate them jointly with the underlying, so we can compute the P&L at different horizons. So in this example, it's also in the portfolio construction risk management book. So you can see how all of this is computed. We simulate the implied volatility surface, the underlying, and then the interest rates. So you can see that this is 3 months options, and then we simulate 1 month into the future, and then we look at the P&L distribution. So you see you have something that is approximating this hockey stick, but it's not very sharp as you would see at expiry, because it still has some time value left. And here, for example, these scenarios, you can see that apparently there's a simulation where the implied volatility increased quite a lot. So you have some additional P&L just from the Vega and not just from moves in the underlying. Of course, there's also some effect from interest rates, but but that usually is a very, very small amount compared to the underlying and the Vega. Okay, so I know we presented many things here today. You can get a very, very deep insight into all of these things by studying the book, and hopefully now you have the right perspectives for understanding these things. The conclusion is just that there exists a practically feasible alternative for the variance-based approach. It solves many of the fundamental problems that investment managers experience in practice. It's just significantly harder to implement fast and stable versions of these things, but they can also be a source of alpha for you if it's not a method that is just easily available to anyone with some knowledge of Python and statistics. Many of the methods that we have, it's historically has been considered solving, let's say, CVAR optimization problems to be as so hard that it's not really feasible. But that's actually not the case. In the open source code, we show you some examples of one way that you can do it with expected return targets. If you want to do target risk and tracking your constraints and things like this, that's more complicated. But it's possible to do all of these things, even though it's much harder. I encourage you to not just take my word for it. Just go in and read this portfolio construction risk management book. Study it from a strict logical perspective, because every time someone does that, they end up with the conclusion that yes, these methods from a strict logical perspective are strictly better than mean-variance, Black-Litterman, and things like that. And then also work with this Python code so that you can see that if you understand the theory, apply it to basic case studies here in practice. Yeah, usually, unfortunately, you will not hear about these methods from university academics because they have written so many papers about mean variance, gauge, things like this, and there are so many books, so many courses, and it seems that the current academic structure motivates them to just to stick to these things and keep selling them as long as they can. So do yourself a favor and do your friend a favor and tell about this different alternative because you probably will not see it other places right now. So also respect to Quant Insider for actually bringing this stuff to you so that you can see what is actually possible if you go beyond the usual academic stuff. So here I still have this blinking screen, okay, but now for the end, I encourage you to stay in touch. So if you want to connect on LinkedIn, please do this by scanning this QR code. But even better, if you want to connect on Substack, then this is where I post exclusive case studies and very, very deep insights that are not just possible in a LinkedIn post. So if you want the most benefits, then subscribe to Substack, but of course also connect on LinkedIn if you want. All right. This was the presentation from my part. And now, if you have some questions, then I will be happy to answer them.
Thank you so much, Anton, for this insightful talk. I think we are open for Q&A. People can put their questions and we will take it one by one.